Thank you all for coming, and thank you especially to our guests, Nachiket Mor and Bindu Ananth, who have very graciously agreed to share with us all of their thoughts and experiences in trying to improve consumer well-being, broadly speaking, but generally in the area of financial inclusion. And I just found out that they have also been peer advisors with the government of India looking into consumer protection standards in India, and they'll share some of that work with us as well. And just to give you some background, Nachiket holds an MBA and a PhD in finance from Wharton, and Bindu has an undergraduate degree in economics and then got a master's in management and has been doing some really influential work in the area of microfinance. So let me turn it over to Bindu and Nachiket, and again, thank you very much. Today's Diwali, so happy Diwali to everyone, and they're going to pass around some sweets as well.
Thank you very much. I want to thank the various people in Colombia for setting this up. With short notice that we discussion, and what I thought we might do is for about 20-25 minutes share with you a little bit what we've been trying to do in this area, and then depending on how the questions go, we can delve into it a little bit more carefully. I will do the main body of the presentation, and Bindu will step in. Let me get to the first slide. So the background for this is Bindu and I both come from a banking background. I worked with a bank called ICICI Bank for about 25 years and was responsible, amongst other things, for our corporate banking treasury, but rural banking for about a decade. And Bindu and I were colleagues in that area. In 2007, I stepped down from the bank's board to try and think about what we might do in the area of financial inclusion and to try and develop an approach that kind of dealt with the problems that we saw on the ground. And what we will talk about is, and what we discovered as we got into it, is that we ended up doing a lot more kind of first principles work than we anticipated when we got started. Initially, we saw our role much more as people building on other people's ideas and just making stuff to scale. But when we got into it, we discovered that actually a lot more was involved on the ground. And that was a few years ago, and we now had some experience of rolling this out and making it actually grow a little bit better. What we found, and this is definitely not new to you, is that in consumer finance, what you see is very much an FMCG kind of perspective. Toothpaste, toothbrush, like selling approach, in which there are several products standalone, and there are people who designate themselves as manufacturers and then try to push this out into the market. So the people selling this product are often agents of various kinds, and these could be banks, not that they are just individuals, but they are often either parts of the manufacturer, the person who made the product itself, and a lot of the emphasis of the system has been on disclosure, transparency, and to some degree avoidance of conflict between the manufacturer and the distributor. And in developing country environments, you see a lot of effort on things like financial literacy as another effort to make sure that products that are being offered to the customer make sense to the customer. We felt that often these measures, particularly financial literacy, for example, are measures that are attempts by regulators and providers to shift blame to the customer. You say, now you're literate, now it's your turn, I can sell you whatever I want, and now you have to and then figure out. There's low emphasis on the expertise of each. Often the provider is not actually very skilled at the product itself. Often products have multiple functions. You get into a little bit into this. Oh, I'm sorry. Can people hear me at the back now? I should have checked earlier. So there is no emphasis on what the agent actually knows, and often what is called a product, and there is a sense of something being distinct between one product and another. The distinction is somewhat artificial sometimes, and there isn't the kind of specificity that you see in manufactured or physical products, and the direction in which a lot of this goes is that customers can choose a variety of things, try to make sense of it all, and put it into their portfolio, and to see what is the right answer for them. And even in the financial inclusion area, you see this as the reform, where you take the village savings and loans associations that you see dominate some parts of the world in terms of where the product work has gone. Or in South Asia, you see coming out of Bangladesh and now India, the 52-week loan product in which there is a standardized repayment schedule every week. And a lot of the emphasis has been on can you standardize, make it simple, and move it up to scale to try and build a product portfolio. Our own sense has been that simplicity as a design principle is not actually a good design principle for financial services. Really, finance, in our view, is almost as near as you can get to a product that is designed on the spot, as it were. This notion of a pre-designed, pre-packaged deliverable is not actually appropriate for finance. It has an infinite degree of flexibility. You can actually design on the spot, and the ability to do something that, in a sense, fits like a glove to the customer is much more in financial services than any other product market. But to give you an example of simplicity and complexity, oftentimes when you talk about financial inclusion, the sense is these are poor people, they're not very literate, you should offer them simple ideas, simple products. And the whole literacy mindset also says that if I'm going to sell people products that they understand, because that's what the whole literacy idea is, then they must be simple products, because otherwise they will not be simple. The question is that the right direction to go? And to just give an example, product A is a crop loan to a farmer. Let's say it's a $100 loan with interest. You pay $10 a month for 12 months, and that's the product that you offer. Simple product, rate of interest very visible. You can compute all the numbers very well. Second product is a product in which gone up there and built a product in which if the rainfall fails, you don't have to pay the money back. If rice yield falls below a certain number, you don't have to pay the money back. Now think of an environment in which indeed there is no rainfall, or indeed price has fallen. Product A, while simple, actually has made the life of the customer far more complex. Because now not only does she not have the yield from the rice or the product, but now she has a leveraged position that she has to honor despite having no income. It's simple for the regulator, it's simple for the provider to offer product A, but not necessarily, doesn't necessarily solve the problem that the customer is facing. Product B, far more complex, far more opaque, far more difficult to explain, right? But potentially has the opportunity to give the customer a smoother outcome as far as her life is concerned. So this is the kind of
ideas with which we went back to try and understand what would good consumer finance look like. And this whole notion of finance as something that has, if you look at the three dimensions in which finance operates, right? One is the time dimension in which it lets you move money back and forth. And the second is the state space dimension in which, depending on the state of the world, you're allowed to move money back and forth. And the third is the geography dimension in which from place to place you move money. The thought was that given that ideal, what you want is financial propositions that are tailored towards individual needs and risk profile, so that you understand what the individual specifically has exposure to each of these dimensions, and can you design financial products that are meant for that individual. For this to happen very well, you might have, because regulation requires it, because manufacturers are specialized in that way. At the back end, you may have many people producing many products, but at the front end, you would have the ability to bring all of this together for the customer. So that depending on what the customer needs, you try and put this together. A very high emphasis on provider expertise, because in order to assemble this stuff, you really have to understand the products very well. You have to understand the customer very well, and then you have to be able to bring the two together, customer by customer. The issue of financial literacy is then replaced by the notion of informed consent, so that you're not giving the customer a menu of choices. We had an opportunity to discuss this with Robert. One of the analogies he gave us in this process was, thank God this approach doesn't work in surgery. When you are being wheeled into the emergency operating room, nobody is coming up with a menu of choices of surgeries to be offered to you, and you are being asked to figure out what is the appropriate choice. The doctor has made a decision that this is the right thing for you to do, and now they're consulting with you to inform you that these are the risks and rewards. Would you be okay with this? Working much more with informed consent rather than with a menu of choices. And then, of course, at the very end, expose liability on the provider if the product that was sold is not a suitable product. So this was kind of a theory, and we spent a lot of time thinking this through. We worked with a variety of academics around the world to put it together. Bindu, my colleague, actually has now a textbook that will be coming out, published by SAFE. It's called Financial Engineering for Low-Income Households, in which we've tried to think about, what are some of the ways in which, what is the new language that needs to come up in order to make sense of this. And at the concept level, looks, question often we are asked is that, okay, can we make this work? Because a lot of people will tell us that even single product delivery at scale has been challenging. What you're talking about is far more complex. Is this at all doable? So what we decided to do is to actually go out and roll this model out on the ground, and develop this KGFS stands for Kshetriya Gramin Financial Services, which in Hindi translates to regional rural financial services. Right? Because our thought was one of the designs, and we can get into this in Q&A. One of the design elements of this was using local financial institutions. You couldn't do this at a single national institution serving 1.2 billion people. Needed much more local presence. Currently, we have 5 financial institutions that we have created, which between them have 140 branches, serve 270,000 families, and 450 wealth managers. The first EPFS that started in 2008 is now fully profitable, and we find now, because the first EPFS has a lot of learning, a lot of back and forth, for which the first one had been made. Now our sense is that it takes about 8 months for a branch to become profitable, and about 2 years from start for the actual entity to become profitable. There's clearly a lot of emphasis on economies of scope, not as much on economies of scale. What we find in financial services is that once you get to maybe 15 or 20 branches, there isn't much more gains from scale. Particularly if you can take things like computer systems and technologies and make them at the back end cloud-based, so that we don't have to reinvent it for everybody. Beyond beyond 20 branches, there isn't actually a lot of gains from building 200 branches, but there is a lot of value in more products, more customers at the same branch. We decided to put our branches in remote areas where our sense was that the services were most needed. That's kind of from a mission perspective, but from a competitive strategy perspective, we were monopolies. There was no other provider, and we didn't expect the provider to come for more than at least for 5 years. Sadly, of course, given India, 70% of the country is in that position, that situation. So it was not as if we looked very hard to find such places. In that environment, we felt that there was no need to build any incentives for product sales. All of the effort and all of the incentives are on customer well-being and on client outcomes, because the natural demand for these products is actually pretty high. And we are able to build an individual financial plan for every single household. Currently, the customer for us is their household. There is some work that needs to be done to break the household apart into individuals. We haven't quite done that yet. We focus on the household and think about what we might do at the household level. The model is branch-based. What we found is that a lot of the costs of banking do not actually come from branches or physical infrastructure. Each of these branches is actually quite low cost. The monthly rental on a typical branch is $100. These are not branches that we build. These are branches that are pre-existing. We just bake them up. Reflect our colors and our brand. So it's very easy to set up a new branch. There is no real reason to, a lot of people tell us use post offices, use other. The cost of setting up a new branch is actually not that much. Clearly the staff cost is there, and they have to be paid. But these are locally hired individuals, again paid in the neighborhood of $100 a month. And at $100 a month, we are a competitive, somewhat of a premium employer in that market. So it's not as if they're getting underpaid. These are remote areas, so they're living right next to their homes or a little bit away from their homes, and most of the money that they have goes into savings or just adds to their income. The branch on the right, the Snowfield branch is in Uttarakhand, which is in the foothills of the Himalayas, and on this side is in Tamil Nadu. All of these branches are in very remote areas. The nearest alternative financial services provider would be maybe 10 miles away from this location. In Uttarakhand, the numbers would be like 30, 40 miles to get to the nearest alternative. The staff are often just high school graduates. They don't have an MBA or a PhD. We do get some MBAs, some masters, some graduates, but by and large, these are high school graduates hired locally. They speak only the local language. English is not a requirement for anywhere. There is a lot of effort that goes into collecting data. You can't come into the branch and demand a product in your first visit and be offered it right away. It doesn't work like that. We do have to get to know you, we have to visit your home, we have to get a sense of your financial flows, assets, liabilities, family members. We spend a lot of time getting to know you and your dreams, your fears, what are your plans for the future. And a lot of this information goes into our automated customer management system. And from that, we try and develop an overall, what we call a financial well-being report, in which you project your 100-year cash flow. You try to understand what your retirement will look like. You try to understand what kind of risks you might encounter over your lifespan, and then come up with ideas around your liquidity planning, your asset and liability planning. One of the concepts that we spend a lot of time making some more precise is the notion of human capital, which is an actually quantified number which computes present value of future income minus present value of future expenses. Gives you a somewhat of a handle on what are your valuable assets. If you think about applying the capital asset pricing model, for example, and you want to think about covariance risk, human capital is an important asset that you're putting into the mix to try and decide what is the right portfolio allocation that actually makes sense. But if you're thinking about protection and insurance, right? We couldn't get insurance companies to tell us, for example, in life insurance, what is the right level of, if a customer is willing to buy as much insurance as we tell him, right? What is the amount they should buy? Is there an algorithm? Most insurance companies couldn't give us a good sense of what that number is. Therefore, we have to spend some time, and there is academic work that is true about this. And then, of course, a lot of this comes through automated work at the back end. The financial well-being report is produced and generated by the system that then the wealth manager uses to work with the household and figure out. There was a mention about our work with the financial services regulator. The government of India has now put in place a new commission that is attempting to redraft financial sector regulation across the entire financial sector. And they're looking at a variety of things. So as you know, like many other countries, India has had a history of new regulation and new regulators emerging. There is a sense now that we may want to revisit a lot of this in the light of recent events, but also development in technology. One of the areas that we have now been able to persuade the regulator, this new regulatory thinking, is the notion of suitability, in which what we are saying is that what matters much more about products and product design, even if you want to follow a product approach, is the product suitable for the customer? Now the question is there a way in which we can actually audit this stuff much better, so that when you are selling a product to a customer, the notion of suitability is made somewhat more precise. Is it possible for us to develop customer types, so that when we say that these types of products are useful, or this profile of customer needs these profiles of products, one can move much more quickly to an optimal product outcome. Currently what we are doing is every customer is treated as a new customer type, which makes optimization a little bit hard. Is there something we can learn from our own historical experience as well as intellectual analysis that makes this fit and suitability issue much better? This whole behavioral issue around how do you get customers to respond to what you're doing and to nudge them in the direction of thinking about their own product suite much better. And then this issue of why we don't have and we do not want to have product sale targets. Financial well-being has been a harder area to define. What do we mean by financial well-being? In earlier discussion today, I was talking to somebody and we said to them that two individuals with identical incomes, identical expense profiles, one of them wants to send their child to Columbia University to do an MBA. One of them is happy to send them to a local government institution. Because they have different dreams, the person that has Columbia as a dream is financially less well off. Because the gap between what they have and what they would like to do is bigger than somebody who has a modest. So measurement of financial well-being will become different, and financial strategies will become very different for one customer versus the other. So we'll have to think about, how do we put this notion of financial well-being together, so that we can actually then get wealth managers incentivized to maximize financial well-being rather than profit's sake, have specific products. So I'll stop here. I can go into a lot more detail, of each of these ideas. But what I thought we'll do is give you the opportunity to push back on these ideas to see what you think is interesting or not, and to discuss them. Thank you.
I have two questions right away. So one is somewhat simple. I'm just curious what the sort of the range of products is. Are you only talking loan products? I know in India there's also cash transfer type things that people use. Is that included? And then if you could just speak a little more about scalability, whether you think this model, how, what are the limits to the speed of spread and scale?
So on the product portfolio, currently each branch offers about 18 kinds of financial products. So in terms of categories, this includes insurance. Within insurance, we do life, which is a pure risk cover for life. There's personal accident, which is disability on account of accidents, not leading to death. Livestock, a lot of our clients invest in cows, buffaloes, mules. That's an important asset. I'll try to speak like rainfall insurance to protect against variability in income. So that's insurance is a pretty big category for us. As it turns out, most clients are primarily insurance clients. And other than insurance, of course, we do credit, which includes both short-term consumption smoothing type loans, but also working capital for shops, for local businesses, and so on. Savings, payments, which is domestic and international money transfers, and a pension product. And so this suite is constantly work in progress, but the idea is to sort of make it as complete. The big sort of missing gap in our product portfolio today is health insurance, and that's really because of all of the complexity on the healthcare side. So even if you do manage to sell health insurance to a client, what facility would they go to actually redeem that product? So, so that's where we are on the product.
On the evolution side, clearly products like commodity derivatives will be the next level which we want to move to, because a lot of our clients are farmers and they have a keen interest in options, for example, being offered to them. So the only derivative they have right now is rainfall insurance. It's really a weather derivative. It's sold as insurance because weather derivatives are not, it's not the easiest way to sell them. But indeed at the back it's actually a derivative product. Eventually we want to offer specific options in futures contracts. But that would be the next stage.
In terms of replicability, I mean, the way we think about it is definitely doing multi-product financial plan is a lot more intense than doing single product maximize customers. So the underlying rates of growth, we kind of keep that in mind. But the idea is to have several such KGFS units. So we have 5 now. Our big kind of ambition is to put out 300 of these, but definitely at least 10 of these in the next couple of years. And the thought is to really sort of define and standardize what the organizational design will look like, and then sort of have them roll out across different parts of the country. So very different than scaling up a single institution to cover all of India, because as you all know, India is incredibly large and diverse. But to define what a good financial institution will look like, and then hopefully proliferate hundreds of those. So replication rather than sort of growing a single balance sheet.
And now that we have about 500 wealth managers in place, right, they can act and they do act as master traders. So now to go to the next level of scale is not that hard. And the training programs have been designed carefully. It's not as if anybody is getting a PhD in finance. That's not the goal. It's very much, but they do have to have a little bit of a sense of central limit theorem. They have to have a good of a sense of probability. So it's not that they can be completely unschooled in the notion of probability, because diversification means you need to understand covariance. Right? But we find that a good high school diploma with a 1 month training program is enough to get somebody, and then a lot of automation in the advice function, so that you're not developing the finance understanding of capital asset pricing model from scratch each time. Right? We already build in a lot of work on what covariances look like. For example, if somebody has positive human capital, right? Let's take a landless labor. They are working in a local area at the age of 21. They would have about 500,000 rupees, $10,000, $12,000 of human capital. All of this human capital comes from local labor, which means that this asset is highly correlated with what happens to the local economy. It's a bad idea for them to be buying real estate locally, because if there is a collapse in the local economy, both human capital as well as real estate investment will take a hit. Right? A good diversification strategy is for them to invest in financial assets outside of the local economy, say an index mutual fund. All this is built into the financial well-being.
How do you educate them about that?
So this is where the wealth manager's skill and understanding comes in. Many people understand landslides, for example. They know flooding. They have in their. It's not as if the risks are hypothetical risks. These are risks that they've experienced. One has to bring in bring all of this into the conversation to help people understand what it is. Right? But you cross the age of 50, human capital is turned negative, right? The logic completely turns around. Now you want to get rid of all your index fund investments and buy a home locally, because now your expenses are entirely locally driven. Like, you want to be sure that your incomes and your assets are actually correlated. So, clearly these are ideas that are programmed into the system, and a lot of graphics, a lot of stuff that they can understand.
I was thinking about the two products that you mentioned, product A and product B. How difficult is it as an institution to manage the risk, especially in a product B kind of scenario? Because, for example, let's say you were to do it in Tehri, right? And Tehri doesn't have crops, but let's say in Tanjapur, right? And you say, if there is a flood, you don't pay for the next 2 years. But the chances are that the entire risk is concentrated in that area. Right, so if you've got 2,000 farmers whom you each gave $100, all that money is at risk for that next 2 years. So how does that risk kind of get managed?
Yeah. So the starting point is that in any case, the institution is in a much better position to manage that risk than the individual. So in product A, while it's simple, you're leaving rainfall risk with the farmer. In product B, the institution takes it. And then your question is, how is the institution now managing it? So I would say that the risk transfer markets in India are sort of in evolution. So as an institution, it is possible for us to purchase rainfall insurance on a portfolio of loans. As a financial institution, I can cover myself against an extreme event. So that in some sense helps me offer that back to the customer. But certain types are harder to do. So political risk, for instance. So if in an entire district there is a rogue politician who says don't repay loans, those markets don't exist. But rainfall, landslides, these are risks that institutions can offset.
So by and large, we are not offering products in which we are warehousing a lot of risks. The only risk we are warehousing right now is credit risk.
Yeah.
Even in credit risk, we are attempting to sell off systematic risks. Right? That means risks of failure across the board, we are attempting to sell it to the market. Right? The risk of our making a mistake about you as an individual borrower, we are warehousing. And that's in fact a service we offer even in cattle insurance. Right? The risk that there is fraud by the insured and the cattle is the cow or the buffalo is still alive, but he claims that she is dead. Right? That's a risk on a first loss basis.
And all the appraisal and evaluation of all of this is being taken care of by the wealth managers.
Yes.
Yeah, that's why we think the branch is so important. Physical proximity is so important because you truly have to get to know the customer, not simply as a piece of paper, but as a living, breathing person that you are interacting with on a daily basis.
And structurally, how are these 450 wealth managers being managed?
So each belong to a particular local financial institution. So overall, that's a non-bank finance company in terms of structure, and they are hired and managed locally.
It's almost like the branch manager, regional manager kind of stuff.
Right, but it all terminates at the level of, say, 2 districts. So we have an institution just for Teg and one for Tanjore. And that's not to say these could be different countries.
Sure.
So we don't want to stretch a single management team across these 2 regions. Amit.
I think that since we were invited to push back against and I also think that I don't know very much about microfinance. So I want to go back to your example of product A and product B. So my understanding of the was that take-up of rainfall insurance is often very low, and that it is difficult to understand how rainfall insurance works. If it doesn't pay off in the first year, then no one buys it. And so from an aggregate, so I understand that obviously we all think that diversification is important. From an aggregate perspective, is low take-up of product A, potential low take-up of product B, better than potentially higher take-up of product A? So that's the first question, from sort of an aggregate. The second question is, once you've decided on product variety as being an important aspect of your business model, at what point do you stop? In the sense that the marginal cost of adding new varieties for you is very low, but the marginal increase in complexity seems very high to the customer. So how do you decide that?
So on the first issue, the Sean Cole paper that you speak about is, his finding was not that the take-up is low. His finding is that trust is an important component of take-up. Right? If there is a trusted intermediary, you actually get very good take-up. Part of the reason we have a branch and that we are locally present is the trust levels. What we are finding is that actually the opposite turns out to be the case. There are some branches that are just doing insurance sales, for example. The issue is the risk a visible risk? Is the risk that somebody understands? And is the risk management product truly a valuable product? Right? Rainfall insurance does have the character that there are a lot of internal coping mechanisms that farmers have. So it's not entirely obvious that for rice, the best idea is to pay the rainfall premium, right? Because the crop is not sufficiently high value. Secondly, it's not, it's a matter of philosophy, but it's not necessary that I must unbundle the product and sell it. Right? So when you're saying customer complexity may rise, I may offer the customer a single product, which says, here is a loan.
Okay, so this goes
If
back
it
to
doesn't
suitability,
rain,
so you're channeling of this.
if it doesn't rain, you don't have to pay. Right? It's going to cost you 0.5%. But I'm not going to offer you the other product because I don't think that's suitable for you. If I sold it to you, I am guilty of missale. Right? Now, obviously, the customer has some play. There is some domain in which I say it's great. You could take this, but I don't think it's a great idea for you. But I'm still willing to sell it because maybe you can manage it. There are some products that I will tell him, even if you want it, even if you are eligible, I will not sell it. Because I don't think this is suitable, liability is not. When somebody buys high value cattle, you buy low value buffalo, 5,000 rupees, $100. You don't want to buy insurance, your problem. But if you want to buy high yield animals, that can set you back $500,000. I will not give you a loan for buying that unless you also buy cattle insurance. A mule, for example, which is in the north you see a demand for it. Right? That's 100,000 rupees, well beyond the total wealth of the individual. Right? If a mule dies on him, he will be paying me back for the rest of his life without actually being able to manage it. Now, the issue of product variety, like derivatives, it's a matter really of, is there a substantial value add? Because while marginal cost may be low at the front end, there's a lot of work involved at the back end. Right? We do not allow product manufacturers to come on to us. What we found is that the costs come from paper. Right? Back ends have to be smoothly integrated. So, for example, we offer a bank account to a customer. The customer should be able to transact on that bank account a minute or less. Right? Because it's thumbprint operated, it must real time connect with the back end, debit or credit their account and give you the money. Okay. Often banks and insurance companies are primitive in their technology infrastructure. Right? They are not prepared. We spend a lot of time with them building this integration. We will do it only if there is, we think, a lot of value at the front end. And we do not offer too much choice. Right? Any color of car so long as it's black. Right? Because some of this language of choice has come from toothpaste industry, pink colored, blue colored. The choice comes really more in the design and in the way the product interacts with you. At least that's what so far we have thought about.
I have two questions related to the economics of the model. The first one would be, what are in your view the key success factors to being financially sustainable as a model? Maybe based on the challenges that you have experienced in the past. And the second one is, what type of a return do you expect from the activities, and how do you balance a potential double mission of aiming to make a profit and still trying to improve the financial well-being of your customers?
Right. So just on the key success factors, at the branch level, what's most important is that we've got sort of the remoteness right, which is to say the location that we've chosen to place the branch should be such that at least 1,000 customers sign up. Typically, we see that happen at the 6-month mark. But there have been a few cases where we didn't kind of locate the branch in the right place, and there were other players and so on and so forth. So kind of getting the remoteness right so that we get the minimum number of customers signed up. That's sort of a key critical factor. Beyond that, like Nachiket was saying earlier, because by design we are a monopoly player, I would be very shocked if then the branch doesn't make money, because you have all of these services, you know the competitor than the money lender, so the branch should be successful. There are of course a lot of people-related factors, making sure that the wealth managers are trained well, and particularly as we grow, these are important considerations. But from a market perspective, it's really about making sure that we are translating our strategy of remoteness consistently on the ground in terms of each branch and being located well. On the other question, we are not really trying to balance sort of mission and profits in any active way. The mission of each AGFS is clearly financial well-being, and that's the purpose of the business. Within that, if we got our strategy right, we think it would be shocking if we didn't make money, because for all the reasons that we talked about. And like everything else, we think capital has a cost. Financial services is capital intensive. So in sort of our business modeling, we target return on equity of 20% and higher, so that in some sense, capital doesn't become a binding constraint for the model. But on a day-to-day basis, we are not really sort of balancing. We are, we know our market, we know our customer, then we are just really sort of almost single focus.
See, and it's also a matter of what you believe is required to make businesses successful. The perspective we bring to the table is to say that unless you're truly solving a problem, whether you're Coca-Cola or you're a bank or you are anybody, and your business strategy is not aggressive hand waving, there is something you're doing, then you will make a lot of money. Our belief is that if we focus exclusively and sharply on financial well-being, that's when we'll make lots of money. If you, in fact, one of the big issues is if you got carried away and started selling loans, 3 months it will look good, then the defaults will start, right? Then you find customers getting stressed out because you didn't think about what did they really need. We found that in some branches where the wealth managers hadn't quite got it, right, or they had gotten it but on the ground you didn't see the execution as you wanted. Right? These branches we discovered were performing financially far below potential because they thought that this is some, mission fluff that we were doing, that this was not core business strategy. Therefore, they missed obvious opportunities of building high quality financial products for customers that really serve them well. So we don't see the actual tension. We see this as a high quality business strategy. And I think somebody from Google said this. First add value, then only seek to extract. If you're not adding value, you're focusing only on extraction, sooner or later there'll be nothing to extract.
How translatable is this model for rural areas to urban poor and eventually to even the lower middle class, where I think there is very low awareness of, or very low financial literacy. Is this model translatable or parts of it translatable when you guys talk about the transitioning into the urban areas?
So right now we are focused on remote rural, and as Nachiket was saying earlier, lots of India actually fit into that category, so we don't expect to take a KGFS into urban markets. But I think the core notion of saying having a provider that's multi-product and who is in some sense organized around the notion of suitability, that to us seems like a very, very translatable issue. The core problem being that most providers are single product providers, and it's hard to start doing multi-product, which is what we had to deal with in the initial years. For example, India has multiple financial sector regulators. So as somebody at the KGFS branch that's doing insurance, credit, mutual funds, pension, we are actually regulated by all 5, which meant that we had to figure out KYC, for instance. Each regulator has a different KYC standard. So there is a lot of sort of upfront effort around kind of having an economies of scope model. But once you get past that hump, so far it seems like a really interesting business strategy. So seems to be replicable broader than the rural market. For us, we've sort of chosen to go to remote rural in a way because it's green, it's completely white space, there is no formal financial institution, and we get sort of a good 3 to 5 years to fully execute our strategy without getting distracted by competition and so on.
The challenge will be as we get into market spaces where other providers are present. And the dominant business model is pink colored credit cards and green colored credit cards. And that's the way everybody thinks about it. That's the way the customer expects to think about it. In that environment, our model will look somewhat paternalistic. Who are you to tell me what I may do and not? And I think there will be challenges. I don't think it will be that easy. For example, even one of the reasons we are super fast is we operate with thumbprint. In India, thumbprint is associated with criminality. Our rural customer makes no difference because he's not aware that actually only criminals give up thumbprints. Right? He's never been banked before. In an open market, it is possible the customer may push back and say, I will not give you the thumbprint. I'm used to doing business in this way, and that's the only way I will do business. So it is, I mean, an open question. Our cost structures are far lower than that of regular commercial banks. So it is possible you could go into this market and do something quite interesting. As Bindu said, we have not thought about that question yet. But my own sense is there will be challenges. When the dominant business model, if tomorrow regulation comes and says you have to sell suitable products, I think things could change quite dramatically. Because now you will have to have processes set up that tell you that you start selling teaser, mortgage products, in which first year interest rate is that and second year interest rate in something else, and if the interest rates change in some interesting way, then third year interest rate becomes something else. You will have to demonstrate to somebody, why is this a suitable product? Right? To whom is it suitable? I think then the opportunity for players like us might become more normal.
So I was wondering if you could just talk a little bit, instead of talking about insurance and products. What struck me when I had the pleasure to go visit some of the branches here, and my conclusion was that what I saw from branch managers and branches and customers was so different than anything I personally ever experienced in financial services. It was just totally different. I want to make sure people here sort of get that flavor for this. And instead of talking about the products, I'm talking about the people that are here. And just an example about what the job of the wealth manager is, because it's not what we do down here in 110th Broadway from Citibank. It's just very different today. How much time they spend away from the branches, what they know about the customers was striking to me. And also this idea of values. You couldn't go more than 2 steps out of IFMR and not hear about how critical values was as part of the training and as part of what was shared across the regions and the branches. So just if you could talk about some examples to let people know how different this really is from what you might think of when you hear financial services for customers.
No, thanks for nudging us about that. So I think one of the most interesting and challenging parts has been the human resource sort of strategy, because traditionally in banking, this has been the issue that nobody wants to go work in the village. So it's kind of, how do you make sure you have people who are trained, who are motivated, yet who are happy sort of doing that work. And so the natural conclusion was to hire from local markets. So the opportunity of hiring from local markets, so that they know the region really well, they're part of the community. But the challenge was often that, they would come with a lot of the biases. Despite all the progress in rural India, there are challenges around caste and religion and so on and so forth. So we knew early on that the whole HR service consistency, these are going to be pretty important issues. And we also realized that we didn't know enough about it being bankers. So one of the smartest things we did was to reach out to a lady who was head of operations at Starbucks, because that seemed to be a business that had really thought about front-end consistency of service, so on and so forth. So we got her on board as an advisor from day one, and she's been an important part of our journey. Her name is Geeta Beja. And one of the things that she forced us to do very early on is really sort of articulate core values of the business, and something that we would be willing to hire for and fire for, something that would be displayed in all branches prominently, and sort of make that active. So to give you a sense of some of the values there, one was that we will meet the customer where they are and without judgment. And the underlying motion there was that we are a professional organization here to provide financial services. We are not going to start judging you and starting to, when a customer walks in to take a loan, of course we have to establish whether we are comfortable from a risk perspective and a financial well-being perspective in the loan. But should you give dowry for your daughter's wedding? Should you send your daughter to engineering college? And there's a bit of a trap that one could fall into being a monopoly provider, that you start sort of becoming the village, wise person and start being an advisor for all kinds of things. So we had to sort of anticipate and articulate some of these things. The other was that we would not anybody found discriminating on any basis, caste, community, etc. All of these would be instantly fireable offences. So that, looking back was, a smart thing that we do, and we're kind of constantly refining that so that each staff member sort of knows where the line in the sand is. But other than that, in terms of the wealth managers themselves, just to give you a sense of their typical day, the wealth manager is responsible for, so they come in, the first thing that they do in the branch, we have a ritual which is meant to sort of reinforce the notion that the purpose of the business is financial well-being. So the branch, which comprises 3 people, would take a customer case from the database and sort of jointly talk about that customer case and sort of do a collective brainstorm on what have we done here, was there room to have done something different, are there important products that we should have offered to this, and so on. So the notion being, start your business day not by filing some paper, but by reminding yourself, what the whole purpose of business is. So that would be the first activity of the day. And then typically 2 people would go out into the village and do an enrollment. And the client enrollment means visiting the house, the family, understanding a lot of the data around incomes, assets, goals, what are your dreams for the future, if you want to educate a child, where, how much, so on and so forth. So a lot of time spent understanding household profile. And then just the sheer task of follow-up persuasion. So there are customers, for instance, when you talk to branches, they tell you that the most vulnerable households in the catchment are those who have a single income, and that single income is dependent on wage labor. So the wealth managers are actively worrying about these households and saying, these guys really should be buying insurance. I have spoken to them about it, but they've not yet done it. I need to sort of chase up and make sure something doesn't happen. So the kind of life and day of the wealth manager is really around sort of thinking about those 1,000, 2,000 households and making sure that they are sort of moving closer to optimality.
And some of the issues that I think we ran into in the early days is that we initially started to hire for experience. Former bankers, former microfinance institution staff. That was a mistake because, there is a certain mindset of product sale, product fishing, just going out there aggressively and whatever it is you do, buy the product. Even though we said repeatedly there are no targets. There were subtle things. For example, Deidre pointed out to us that while you're saying there are no targets, when you walk into the branch, the first question you ask the branch manager, what is your loan volume today? The signal he gets is that, well, these guys said it, but they didn't really mean it, right? And if you had somebody that has been schooled in a very, urban commercial bank environment where they are really pushing hard, and this connection of, the question that was asked earlier, is financial well-being consistent with profitability or not? We believe very strongly it is. But for the wealth manager on the ground to get that connection sometimes is hard because you might actually be telling somebody who's coming to you for a very profitable loan that I don't think it's a good idea for you and I'm not going to give it to you. Right? At that particular point, it seems like a profit minimizing decision and not a profit maximizing decision. To see the point that over a period of time, this thing adds up into actually a true blue 100-year, market cap maximizing strategy is a little bit harder to see. And that's why these rituals became important. Even in the rituals, what we learned, and we fortunately, because we had Deidre with us and she was like number 2, number 3 in the Starbucks hierarchy, we got to see what Starbucks does behind the scenes. Right? We spent 2 days in Washington, D.C., looking at what's actually happening inside the Starbucks machine. I think we didn't fully appreciate these things until we started to see problems at our end. So we had a wealth management ritual. But in some cases, we found that it had become just a formality. It was not having the kind of impact that it had. Then we came across a paper, some of you might have read already, by an academic, Christina Legari. She studies religious rituals of the Brazilian tribals and tries to ask the question, what are the more efficacious rituals? Why do some people believe these rituals matter and these rituals don't? Right? Because objectively it's hard to say. Empirically it's hard to determine whether this works or not, but yet some rituals attract more belief, some rituals have less belief. And what she finds is that highly specified rituals, which specify time, steps, have more power than rituals that are broadly lived. So she described a ritual in which if you want to know who your likely life partner is going to be, then when the full moon is out, you wrap a piece of paper in exactly 4 parts, go to that particular tree, take a knife, poke it through that. There's an actual set of steps. Right? This is a lot of power, that ritual. And a lot of people truly believe that that's, the first letter of the name of that person is going to appear in that piece of paper. Right? Starbucks, when you see how they do their coffee tasting ritual, right, before the branch opens, has that specificity. You have to sit down, you have to, there's a ritual there. We discovered that there is a certain academic logic as well as a practical logic why something like this. So a lot of this stuff is being incorporated in our new learning on the ground when we say what needs to be actually done to make sure that even if you don't quite see the strategic link between financial well-being and market cap in the long run, on the ground you have firm belief that this is what you're supposed to do.
Has it been difficult to develop metrics for gauging the financial well-being of your customers? And have you been approached by any commercial institutions that are curious about how you incentivize your wealth managers as opposed to how you do?
So, so that's kind of ongoing work to figure out what are the right metrics. In the meanwhile, we decided that until we know better, let's not go with any sort of variable pay. So it's all fixed pay. And there's a lot of non-monetary means of recognition. For example, we promote aggressively from within. So wealth managers who come in their first job, they're 21 years old, in 2 years they become a senior wealth manager, and we are always reminding them that they have a shot at becoming CEO. So there is kind of non-financial growth type, but in the meanwhile we are keen to sort of understand what would be good ways to incentivize. So what Nachiket mentioned, developing a financial well-being index at the level of the village. To say, think of this village as one giant household. If we were doing our job well, what was the portfolio of services that this village would have versus what they have now? And the closer they are to ideal, the better job the branch is doing. But that's kind of an index that's working in process.
Do you sense that that's enough right now for the wealth managers? Yeah.
So our sense is that the worst thing would be to be confusing or inconsistent. So for example, no kind of product incentive ever will happen in a KGFS. So I think in some sense that takes it off the table, and that gives everybody a sense of that's not what is valued in a KGFS. Then the question is what else? So what, for example, we are struggling with is, in this environment, how are we able to distinguish between the fantastic performing wealth manager and the average? And currently we don't have a very good way of doing that, which is why some of these metrics are important. We know that the bad stuff is not happening, but how do we make sure more of the very good stuff happens? I would think that's where we are a little bit lagging behind. And so some of those metrics are important. But there's really, not many people we can learn from in the financial services industry.
I'm just wondering if they've come to you and said,
No, so
don't
where-
want to be as product driven,
No,
maybe there's
where-
other ways.
Well, I wish that would happen. But where we have been approached is a lot of people have been very curious as to how is it we are successfully operating in these very remote markets? How are we able to, one example I gave, in fact, one of these branches, well, not this one, but in this location, was our first branch. When we started it, I asked a local commercial bank, how much business do you think I would get here? His sense is, we've been here 100 years, maybe $200-300 at most. Right? It's a dusty little place, nothing's going to happen. We've crossed $1 million of business there. Consistently, high quality, low default, and we are very profitable. Yet there's no target. Yet every household is being served only if they need the loan, they get it. Right? So, there is a sense. So we have now a deal with one of the large commercial banks, in which what they have said is that we're going to give up our strategy of doing our own rural financing on our own. We don't know how to do it. You guys seem to know how to do this. All we're going to do is set up a branch that's going to act as your back office. So for every one of their branches, we have 8 branches. We told them where to set up their back office. That branch has been instructed to do no business at all. Of course, by law, if a customer does walk in, they have to serve that customer. But they will not actively canvass any business. And more than one bank has now approached us to do this. Because nobody really has a good sense of how to operate in these hostile, low-return environments.
I would imagine at some point you might have been concerned that the commercial banks would steal your most valuable wealth managers.
Our goal at the end of the day, IFMR Trust, the entity that Bindu runs, is a non-profit. Our mission is universal financial inclusion. We are waiting for that to happen. Let people copy it. We publish as much as we can, talk at fora like this. We have set up meetings now with every single bank in the country, with the CEO, to explain to them the core ideas that we have. So that with the hope that at least some of them will start to use them. Because I don't think we can get this done. 1.2 billion people is far too many people.
And you've already inculcated the values in your managers. So they go out, they've got the values.
Yes. I mean, I would say we still need to do a better job of that. We are making good progress. But I think that's a challenge. Maybe it will be an ongoing one at all times to make sure that they really truly believe it and live it. You had a question at the back.
Yeah.
Sorry.
So, given that you seem to see a lot of value in selling products where you're mitigating risks for like sets of people whose outcomes are highly correlated, like rainfall in a whole village, is it fair to say that you do not see value in one of the features that comes up in this Grameen Bank system, where you have groups of people, groups of families come together, and they serve as collateral for each other? Where again, with in terms of rainfall or something, the entire group goes away. Can you speak a little bit about the social impact of that? This notion of a sense of cohesiveness as groups of people come together to avail of financial services versus not providing something like that.
So I would say that we don't fully understand, how that dynamic plays out. What we do know is that in the absence of formal financial services, there's a lot of informal, group-based that happens at village level, and there's a lot of literature, history, and others who study this, which is clearly inefficient, which means you're trading risk within the village, and so clearly for covariant risk, that's a bit of a problem. So it's kind of a second best alternative that has emerged in the absence. So when we go in, my sense is some of those mechanisms are probably getting chipped away. So instead of insuring with your neighbor, you now insure with the financial institution. And so we don't have a full sense of what is the social capital impact of that, and that's an evaluation that Rohini Pandey and others at Harvard are doing, kind of where we're rolling out our branches. But our sense is clearly it's welfare enhancing to get people away from village level risk sharing to much more formal base of risk transfer, because it's cheaper, it's more reliable, and yeah, in some sense that is the enemy.
But it's not as if we don't offer the product. This is also one of the products available at the branch, the group-based product.
But not the insurance.
What we are trying to do is to get people away from informal, this kind of structures, which we think, what Grameen also found is that either you get 100% or you get 0. A lot of the issues that you saw that MFIs got implicated was not as much MFI loan officers chasing clients. There's clients chasing each other. Right? Because the impact of a loss of 10,000 rupees on an MFI is not that much. But for a group member that has to now bail out their neighbor, that's a lot. Right? And they will go pretty far to make sure that they collect it. What Rohini also finds, and we are participating actively in this research, is that this idea that there was social capital that created the group, it's not quite accurate. It actually gets built over time. As you meet, as you interact, that's when social capital gets built. Maybe there are other opportunities to do that, not necessarily loan-based opportunities. There's also this notion, and some of you may have more experience of this than even we do, of in Africa, for example, even in India, you see village-level savings associations in which people put money, Roskas, people put money together and then one of them borrows. To us, all of these are signals of failed financial systems, right? Because would you lend to your neighbor in your apartment? Of course not. Right? You'd say you go to a bank. Right? Why should I lend to you?
Somebody invest.
And if there is a failure locally, my life savings are gone because you didn't make a good business decision. I would much rather that I deposited money with a national institution and you borrowed money from that institution. That even if you fail, my sympathies will be with you. I will work with you to figure out what to do. But my money is still very much intact because I didn't give it to you. I gave it to it's high risk venture capital actually that you're doing with your neighbor.
You could have problems with national institutions in certain ways.
No question. All we are saying is that there are separate ways in which one attempts to mitigate that and think that through. I agree with you, and many countries have mismanaged it, that aspect of it. Our own sense is that's a better design.
I'm curious about the social connections between the wealth managers and I mean, I can see that brings a lot of positive, they're well informed, they're better able to judge what people can products can be. But aren't there also negative aspects of that? Don't you see wealth managers sort of giving out too much to their friends or discriminating against the guy who didn't like it in the village? I mean, is there really a social structure in the village?
Yeah.
Shouldn't that?
So we follow the time-tested Grameen principle on this. We hire from the community but not the same village or neighboring village, so that there is no active conflict of interest. So that's one. And then we actively move wealth managers across branches. So the benefit we have is it's a very geographically kind of concentrated branching strategy. So the distances are not that much. So we don't place wealth managers in the same village as their own, and we kind of move them across so that there are no kind of long-term relationships that
you don't stay in the same.
But you actually see the concern actually is more the reverse. There are lots of biases that people come. The drunken husband is a popular stereotype of the village name. The whole caste issue. In India, we name the religion, we have it. Right? And that religion has a particular perspective on everybody else. Right? Now, you can start to see biases creeping in loan behavior, in the number of approvals that are being granted, and that's often the subject even of audit. Partly training to make sure that you get it out of your head. That's why this value of we meet the customer where they are without judgment. And this notion of alcoholic, wife beater, right? They may not have direct evidence of it, but they see that man come in. That's the picture that's there in their head. Right? So you have to be careful about that. I don't think we have the answer on it, but these are very much issues that we worry about actively.
And for example, DIDA made us do a uniform for all wealth managers pretty early on. And that was really smart because there is a lot of kind of signals of your religion, and so a uniform in some sense, at least there are no overt symbolism, and there's a sense of I may be who I am in my private life, but once I wear a KGFS uniform, I have these 10 values. So just we are finding, much to a surprise, that some of these small things.
No, in Indian Army, we had a lot of our CEOs from the Indian Army. People at 45, 50, they retire from the Army and they get an MBA. The local business schools offer MBA specifically for these people. They take a year to get their MBA. Right? We hired from these MBA schools. We discovered that the Army has really effective ways in which, because Indian Army is indeed a national army and has had a very good record of operating in very difficult environments in a neutral manner, largely neutral manner. So visible religious symbols are just not, no matter who you are. And these were ideas that had to be, kind of brought in. You had another question?
The brands for everything is KGF in the products, right? Nothing, from what I'm understanding, I'm not sure whether they are being white labeled or are they being treated within KGF. That was one piece.
Yeah.
The second question I was thinking of was, I was thinking about the ITC model in terms of the e-choppers and stuff in India. And do you guys, given that you have physical structure already present, are you guys really looking at, I don't know if cross-marketing is the right word, but really utilizing these spaces to better the lives of people in those markets?
So on branding, so KGFS just kind of is referring to a particular model, one that has financial well-being as its goal, not product-centric, so on and so forth. So sort of a category brand. The real brand for each institution is a local name. So the Tanjavur institution is called Puduar, which is just a local river, and it's a Tamil word. So a customer would refer to the Tanjavur operation as Puduar, no
but
KGFS.
Puduar will be common across the 18 products.
So there are no product brands. So products are just kind of solutions at the back end. Institutions.
But it's visible to the customer. If ICICI makes the life insurance or
Sure.
So it's there in the fine print.
Right.
We don't allow buntings and advertising inside the branch. The branch looks like this, but if you go to the branch, one wall will have each product manufacturer, small.
So the checkbook would still be, say, an ICICI check?
Yeah.
No checks, we don't do checks.
We don't do checks, but if you offered something, the law is very much adhered to. The customer is fully informed. For example, if they are buying a mutual fund, they know which mutual fund it is, they know it's not a bank account, they know who they are, but there's no overt advertising.
And on the second question, so now we've said okay, these branches will just be financial services branches. We got approached by a variety of rural marketing type efforts, but it seemed like it would really compromise the integrity of what we were trying to do. So, I mean, the real estate is an interesting one, but we see a value to keeping it completely focused on financial services, and it's only staff sit and operate.
See, and also, this is the hard one litigation. A lot of players would want to come in. The space itself doesn't cost that much. It's really more the customer trusts you.
Yeah.
Can I free ride on that trust? Right. Our view is it needs expertise to sell it and to understand something. We are barely able to cope with understanding financial products. To build an expertise in selling fertilizer, mobile phones in a way that's consistent with well-being of the customer is a whole different ballgame. And we discourage our staff from getting into anything outside of financial services. If you're wearing the uniform, the only thing you can talk about, you cannot even talk about this school is better than that school. That's your decision. Or why don't you go and get a buffalo?
Because the minute you say that to the customer, the buffalo dies, something else goes wrong, the customer turns around and says, well, you told me. You know, and I don't know what the right answer for the customer is. All I know is, and I barely know that, what is a good financial product for you?
Are you facing any socio-political backlash from money lenders or local politicians, given that their traditional model has been disrupted by what you guys are up to?
We get some money lender backlash and vandalism, and but it's all part of this. Yeah.
But the political response has been actually quite positive. Local politicians, local panchayats have been actually quite positive about this. We've got letters from local government to say, why don't you set up a branch in our village? We had a situation in which one of our branches, there was a theft. The whole safe in which we had kept stuff was stolen, including stuff that belonged to customers. We had a visit from the village elders in the local government to say, don't leave. This stuff happens. You know, we will work with you to figure out a solution when we need you in the community. Often the panchayat head is an early customer because they see the value of what they are bringing. So while we stay away in any conscious way, for example, the panchayat will offer us free land, we will not take it, you know, so we make sure that we keep the distance. But political response actually has not been bad at all. Now we'll see, you know, it's just been 4 years. These are long cycle things. There might be longer term issues that we need to worry about. But in the near term, there hasn't been any issue.
So early on, when you talk about, ways to select and manage agents, you talk about not selecting someone from the local village and move agents around from time to time. But you also talk about the importance of maintaining trust with customers. Yeah. So when you move agents around, will that, discontinue the trust already built between an agent and customer? If that's the case, how can you rebuild that trust?
So the primary relationship is between the customer and the branch, so that it's seen as an institution. It's not about a few individuals. But obviously, like you say, there's a lot of tacit understanding and so on. So we also try as much as possible to make sure that the wealth manager is kind of systematically recording everything. Every time I have new information about you as a customer, I have to update your kind of primary database. I'm sure there are gaps there, but the idea is to say, let's kind of define the relationship at the level of the branch so that we're not hostage to individuals in a good or bad sense.
Kind of building off this dynamic relationship between the wealth manager and the customer, is that the main touch point for the customer in terms of improving their financial literacy, or do you offer workshops to customers as well as kind of
So that's the only sort of interaction between the branch and the customer. So the wealth manager is the only customer-facing part of what we do, and I would say that interaction is what one might think of as the customer education or financial education, and that dialogue is what it is. We don't do anything separate from that.
Because the notion is informed consent in the context of what you do. There are some universal ideas. Human capital is a universal idea. But our sense is it receives much better. Whatever evidence we've seen, academic evidence, or workshops, or general conversations like this on financial literacy, the actual impact of when they leave the room on their behavior is minimal. If anything, in stock markets, you see riskier behavior taking place because now there is a sense I'm an expert. So I'm going to go out and buy IBM, sell this. I have no idea what I'm doing, but I'm just going to go out and do stuff. So our sense is, let's do this in the context of what you need and where it makes sense to you. The goal of the wealth manager is every single household is contacted. It's not as if I contact only a few. The first month of the branch opening, there is no business done at all. Everybody is in the field. And the goal is 100% enrollment. There are branches that are showing 95% penetration. We don't have 100% yet. There's always migrants, there are always people that are not quite connecting with us. But we've gotten to 90-95%. But if you've not crossed 60-70%,
in a 2-year time frame, we would really worry about your branch. Because either we've located it badly or you're doing such a bad job. Because if you've located it well, there's no choice. The customer has to deal with you. Why? What are they doing? Our belief is you exist, you need financial services. Right? So why is it that we are not able to serve?
I have a particular interest in education, and it's fascinating how this is both raising financial awareness of entire villages and also employability of high school graduates, right? So I'm curious to know, after the upfront training, the 1-month training that you'll give, what is the intensity of ongoing support and management of the wealth management?
There's quite a bit. So, there are, for example, fortnightly wealth manager cluster meetings of a particular area where, they would kind of pick a topic and talk about it. Sometimes it could be human capital, sometimes it could be about a specific product. So we encourage a lot of ongoing sort of peer learning. We've developed sort of a learning management system, so we sort of send out a quiz every month. So you don't have to come in to do that, but we will track your scores and kind of key concepts. So I would say, and every time you are rolling out a new product, because the onus of expertise is on the wealth manager, they have to really get it. So there will be a training around that new product and how it fits into financial well-being. So I would imagine that the average days of training in a year for a wealth manager, not counting the upfront 30, is easily about another 30. So we use Saturdays, we use some of that.
Now we are rolling out multiple levels of certification. So level 1 certification is when you get employed right away. 6 months later, you have to cross level 2 certification. And our sense is this is going to be an ongoing journey, because we think every 6 months you need to reprove to us that you know what you're doing. Because ideas, covariance is a complicated idea. You didn't get it, which means customers are not getting it. Which means we found a customer, for example, in a branch where he had taken his entire wealth and bought yet another home right where he was. The wealth managers clearly hadn't spoken to him about the need to diversify, right? Because they had not fully understood it themselves.
So just taking that example a little further, how would you deal with that in terms of consequences or ongoing support, or I'm just curious to know whether that's...
So in this particular example, we diagnosed that everybody is uncomfortable with the notion of diversification and this sort of home as a financial asset versus home as a really, how can you go and tell a customer, sell your house? That seems, isn't that in conflict with our values? So in this case, it was a deeper, and how you had to respond to it is, starting from the CEO downwards, we are running sort of a refresher on diversification, how it fits in. But if you systematically see that there is no evidence of it, clearly the branch is not performing.
And if you don't clear certification requirements, there is a clear signal. There is a lot of support offered, because obviously people are well intentioned and keen, and the selection process is such that high quality raw talent is coming. If they're not making the grade, it's often because they're not really interested. They're not getting engaged. The daily ritual is actually a daily training program, right? If you're not engaging with it, that's why you're not learning. Because every household offers an opportunity to retest your idea. We have this 4-part framework, plan, grow, protect, diversify, right? Plan is simply cash flow planning, grow is about loans and savings, protect is about insurance, diversify is about investments, right? So we have a framework that is in itself a training program. So we are out of time. Thank you very much for your patience and for listening to us so carefully. One of the objectives of this was to try and make this work more visible to a somewhat broader community, so that if you have ideas, if you have pushback, it's very much work in progress, as you might have got a sense of. We think we have made good progress in the 4 years we've been at it, but there are lots of areas in which we need to do this work, and there are already some senior academics here that are engaging with us. We are eager to have more of you engage with us, more of you help us think about these issues, because as somebody pointed out, we fundamentally believe that consumer finance, rich or poor, urban or rural, has to be done in this way. multinational FMCG companies have taken over the business of consumer. I come from corporate banking. Corporate banking runs like this. You cannot run corporate banking in the way you run retail banking. Right? The customers will throw you out. You have to spend a lot of time understanding the customer. People believed it was not possible to do in consumer banking, it was too expensive. Right? Newer technologies, newer approaches are showing us that actually if you didn't do it that way, you're going to make a mistake. You're going to end up with large pockets of default, poorly served customers, customers that are not growing as fast as they should. So there's a lot of commercial value to it. And our goal is to demonstrate first to ourselves and then to a wider community that it is possible to do it, it's possible to execute it, and to do it in a highly profitable manner. Thank you once again.